Hey guys, and welcome to Road to Forex. Of course, my name is Alex, and as always, I'm appreciative that you guys are here with me today. So we've got a really good episode on our hands because I'm going to be going over how to create a scalping strategy from scratch, which can be used in both the futures and the Forex markets. How good. So whether you're branching out or you want to start, you're interested in either of those markets, this will be good for you. What we'll do by starting this strategy off from scratch, by the way, is walk you through not only how to create a strategy, but give you something that you can actually make money in the markets with. How good is that? But before we jump over into the charts and really start this, leave a like, please comment on anything. If you've got any questions or you've learned something, leave a comment, right? And subscribe to my channel. So let's get into this. It's going to be part one right here. We're going to get onto the charts. We're going to get everything set up. We're going to look at what we want. And then part two, we might be going into your entry rules, your exits, that sort of stuff. So let's get this started right now. So you can see that I'm on USO USD right now on the 1 minute. I love this chart. It works really well, and I'll go into it a little bit later. If you want to follow it for you guys that trade futures, CL1 technically is the chart that you want to follow, and it's this NYMEX futures one over here, right? That's what you want to be doing. But we're going to leave it on the 8 cap chart for now. So why are we on the 1 minute? Why wouldn't we do something like 15 minutes or 5 minutes or 10 minutes? Well, the 1 minute, it can really surge up and down quite quickly, meaning we don't have to be in trades for super long. And because the market moves really quickly, we've got many opportunities to hop in, which means that even if we do pass up on some good opportunities or some poor opportunities, we're almost guaranteed a trade. Whereas if you're in the 10 minutes or 15 minutes, especially if you don't have a lot of time, you're under more pressure to actually hop into trades, right? Because you might only have 2 opportunities. Whereas the 1 minute, it's quite endless. So we're going to get into it now. So if I'm going and looking at the charts, I want to enter an area that's going to make a lot of sense for us. And there's nothing that makes more sense hopping into an area, especially if I go over here, than a range-bound market. So the first question that we always ask ourselves when we are hopping in to the markets is, 1, what type of market do we want to hop into? Right? What do I mean by what type of market? Because this could mean, do you mean Forex, futures, this? No, I mean like the market structure. What's going on? What's actually happening on here in the charts? So we're going price action right now. We're not going smart money. We're not going ICT. We're going to be going price action, and we're going to be using some technical indicators as well to help us out. Why would we do this? Well, because it's going to be way more beneficial for you guys. If we use technical indicators, that means you and I are always looking at the exact same chart. Whereas if we use something like smart money, where you have to draw out support and resistance zones and stuff like that, well, it can get more into human bias, and that can be a problem. So why are we then hopping into a ranging market? Why does that make sense? Well, we know consolidation doesn't make sense because that's better for smart money and the higher time frames. Consolidation on here, we can just be in it for 5-6 minutes and then we'll just burst out of it. There's no real easy way to determine if we are going to be hopping into the market. And it doesn't give smart money enough time to hop in as well, so you can't really trade SMC. Now, we could hop into trending markets, but it's not as easy as this. See, a ranging market like what we have here, especially on the 1 minute, right? If we look at something, maybe I actually draw it more like this. And in fact, it actually starts from all the way over here, which is great. It's almost predefined. Like I can see into the future, because what happens with these markets? Well, it's pretty simple. We hit a certain area and then we bounce up, and we hit a certain area and we bounce down. And because we're in 1 minute, we can literally bam, 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 hop up and down quite quickly, which means we've got multiple areas to enter into, which is what I said before, which is really good. And we've got really good take profit areas and great places to put our stop loss. So that's why we're hopping into ranging markets, which makes a lot of sense. Now, the downside to this is that we do have to wait for a range to actually appear. Right? That's what we're doing. So let's go into how we actually define what a range is. Because we've looked at this, we know why we're hopping into it. Good for take profits, good for stop losses, and we can get into, well, we have multiple opportunities to hop in, which is really good. How do we define it? So a definition of a range, according to me, Alex, is, well, I wish I could spell, double top and double bottom. That's it. That's how simple a range is. Once we have a double top and a double bottom, we're in. Now let's define tops and bottoms. It either means that we've got two highs and two lows in the same place. Guess how we figure this out? Use this indicator. If I type in higher, high, lower, low, and I go in the live version, you can see that we've got a high and a high here. And we've got one low here, and now another low down here. Because this says high, right? So we know it's a high, and we've also got a higher high right next to it. Double top, and then we've got 1, 2, a double bottom. And you could say, well, Alex says lower highs and highs in here. Does that invalidate it? Of course it doesn't. Hasn't broken above. As long as the double tops and double bottoms haven't been broken, we're fine. What does that look like for us? Pretty simple. If I get rid of all of this, this is an example of a double top. This is an example of a double bottom, right? Easy. So, if we're looking in a range, that's perfect. We technically have a double bottom here, potentially, but that's a double bottom and that's a double top. What, therefore, would break that? Well, if we've got a double top here, and then we come down, and then we do this, and then we find a double bottom. So now we've got a double bottom and a double top, but the tops have been broken. Well, that's not going to work. It's the exact same if we just move around here for a second. We go up, we go down, we go up. We've got maybe a double bottom, something like this, right? Here and here. That's not going to work because the bottoms have been broken. So that's not okay. It has to be continuous. Has to be continuous. So that's what we can see here. Double top, no tops are broken. Double bottoms, no bottoms are broken. Because this one is obviously stopping here. And this one over here is obviously stopping here. Within the range. Perfect. So now we know what a range is. Now we know why we're going to be hopping into it. Let's try and figure out what is going to help us hop into this market. What is going to give us confirmation that we should be hopping in? There's a few things that we could be going over. And I want to go over all of them so it makes sense. Number one, we need to look for a retest. And we need to look for, after the retest, an impulsive slash, right, engulfing move back into the range. So what does that mean? Well, once we got our double top or a double bottom, let's say that it hits here, it comes up, hits down again, right? Because there's your first touch, there's your second touch, and from there, we shoot up like this. If we were coming up here, it's the same thing. We come and we touch it once, come down, touch it again, push down. That's what we want. Why do we want this? Because if we just wait for the first touch, there's always the potential that it's just going to break up and we might be messed up by a fake out. We might be messed by a lone wick. Something like that could easily take us out. And we do not want that, because that's the possibility of what's happening. If we just hopped in here, for example, even though it then followed the range, we would have been taken out. And we do not want that. That's not something that we need. It's a headache, right? So let's just delete this stuff off here, and then we can go through what else we need to be looking for. So we really want to make sure that we are not getting messed up by fake outs, right? We need to be really aware of fake outs when we are trading ranges. And how do we do it? Well, we're already looking at the retests, right? Already looking at the retests. So we are not hopping on this first move, but we also need to be aware of volume. Volume. And this, we can use the awesome oscillator. You would have seen it in other videos. I'm going to use what I know, what is basic, and what you can understand. I could go into different Lux Algo ones. I could go into paid indicators. I could go into so much more than this, but it's a basic one. We don't need to go into this. If you want to learn more, roadtoforex.com. I can help you out over there, and we can turn this basic strategy into something amazing. So I'm going to go on here. Just to make sure that you know this, red bars, green bars. Green bars mean that there are more buyers coming into the market, more buying pressure. Red bars mean there's more selling pressure, more sellers are coming into the market. That's just a general overview of how to use it. So if I'm getting all of this down here, I know there's a lot of volume, I can see that this is descending, right? It's going down and down and down. I probably know that it's going to push through here. What's going to happen in this example? Right? It does. It pushes through it. Why did I think that was going to happen? Because we had a lot of volume to the downside. Now, it didn't happen where I thought it was going to happen, but it did happen because we had a really big and strong push down. So I don't want to be hopping into that. So by looking at the volume, even if I wasn't going for a retest, I can start to go, I think it's going to push through. I can still wait. And this then raises another question. When do we actually define that the range has been broken? When do we define a range has been broken? Because you could be looking at this and saying, Alex, it broke above. The range is discontinued. No, it's not. Because number one, we run into the problem of what do you actually classify as a break? Because I do this differently. Ranges to me are really, really strong. So in order to say, hey, a range has been broken, I need to look at certain things, which is a retest and an impulsive move. So if it does break out of these lines that I've drawn, which because I've drawn them and I'm a human, I can mess up, right? Doesn't mean that it is right. I want it to come down, hit here, and have an impulsive move. That's what I want. This didn't happen. What's happening right now? Yes, it's broken through, but guess what? It just came straight back up. Just came straight back up. There's no retest. There was no impulsive move the other way. That's not what we're seeing. Let's zoom out and go to a different range area and see the same thing. Maybe not. In fact, let's have a look at this. This is perfect. There is a range, quite clearly. Let's just say the bottoms are there for now. Let's just say the bottoms are there. This is a range. This is okay. What does this not have? Well, it breaks out. Fair enough. It's broken out. Breakout traders hopping in here. They're already losing because you see what's going to happen. And it comes down perfect. But what happens afterwards? Is there any impulsive move away? They're tiny candles. Look at this area here. Look at it, right? Especially if I get this ellipsis out here. What part of that is impulsive to you? Nothing. There's nothing there. It just slowly moves up, moves up, moves up, hits this area and comes down. What about the same in this area? Yeah, they break through, but they come straight back up every single time. It's not until this, right? Where we have, first of all, a massive breakout here. We come down. What happens once we come down and hit this area? We shoot up with this engulfing candlestick that is also impulsive, which takes out all of these candles in here. Gone. See you later. We're finished. That is a breakout for me. So until that happens, we are not classifying the range as dead. It's just not going to happen. So what have we covered already? We covered why we want to hop in, what's good, what counts as an actual breakout, which is going to invalidate the range. It's going to invalidate the range, and what we're looking for potential entries as well, which is for it to come down, hit here, and push out. How good's that? Let's think about another disqualifier that's going to keep us from hopping in, right? Apart from obviously looking at these areas and saying, hey, I think a fake out's going to be coming. A range within a range. What is this? Well, I have picked this area on purpose. And if you look at the dates that this comes out, you will see that this only happened the other week. This is not me going back to some obscure time. This is actually quite handy. So what's going to happen is it's going to come up here, and what does it do? Starts to consolidate. It starts to form a tiny range. Right here. Double tops, double bottoms. It's a range within a range. Or you could just say it's consolidation. So either consolidation or smaller ranges. It's really consolidation anyway. That's going to keep us from coming out, because if we're going to be hopping in, we know it's just going to be bouncing in between these areas. There's no real good place to hop in. Any impulsive moves that are going to really show us any entry, they're going to take up half of your space anyway. And like what I said with consolidation earlier, they can just boom, disappear. They can just take off. And you don't want to be doing that. We want to be hopping into the natural flow of the market. That's what we want to be going for. So none of this stuff. So we've looked at potential disqualifiers for hopping in, right? We've looked at when a range is actually a range and when it's not. That's really important. We've looked at certain things that can show us when fake outs are going to happen, and if they are, by looking at some volume and going, okay, I'm probably sure that there's going to be a fake out coming through here, so I need to be wary. And we're using retest and impulse / engulfing moves to make sure that we're not getting faked out. So, what else can we use in here to confirm that we actually need to hop into these moves? Well, order blocks. Order block detector by LuxAlgo, it's free. This is not the best one. If I go on my indicators, there is LuxAlgo price action concepts. That's a paid indicator. And as I said, I want to give you free stuff, but there are ways to make this even better. But I'm not going to go over stuff that you guys have to pay for. There's no point. So let's get into this. It's probably going to be the last thing that's going to help us set up through here. And then from there, we can just keep on moving on. Apologies if the screen just went dark there. All I was saying is we're going to look at order blocks and see what is going to be going on. This will be the last thing that we go over. Okay, so why order blocks? Why are we looking at it? Order blocks give us a bullish indicator or a bearish indicator. Because what do order blocks do? If you've watched the video that I already have on my channel, then you're going to know, because I'm not going to go into too much detail here. If you don't know what order blocks are, quickly pause this, watch the video on order blocks. But they have selling pressure and they have buying pressure. They move the markets in certain ways. So that's what we're looking for. So if we're going for a buy, for example, somewhere down here, right? I can see there's an order block right here. So this is really going to help me out. So when it came down into that order block, I could have been going, okay, it's probably going to push the market up. Yes, we take it out, but what happens as soon as we take it out? We shoot up from there, because we came into that liquidity area and then we pushed off, we pushed up. That's fantastic. What happens if we come into these order blocks up here? Let's find out. Oh, come in. We're starting to respect them. Just like the last one, we're in that order block area. I think we come in, we're going to take it out. We formed another order block. And then we fall down. So we just respected this last area. Maybe we took it out just like we did down here. And then we fall down. So let's look at, in the next one, how to hop in. How this is all going to make sense. What are my entry rules? What are my exit rules? And maybe go over the disqualifiers one more time. Just to make sure that we're 100% on it. So now that we're all set up, we know the principle behind it, then we can hop in. Last thing in terms of me talking, just remember these are all in minutes. So this could, you could potentially, from the double top and double bottom, have one area to hop in, 2 areas to hop in, 3, 4 areas, maybe even 5 potential trades. So we're going to go over all of them, see what would have worked, what didn't, and maybe even look at what our win rate is at the end, and looking at, suggesting a few things that are going to help us. Alright guys, until then, I hope you've had a good one. Get ready for the next episode because it's going to be great. I will be releasing it on Thursday, and that's going to be the normal scheduling time. Until then guys, you have a prosperous trading day, and I will see you in the next one. Bye.